Let me start with a situation that I know way too many people watching this video have been in. You work hard, you save money. Maybe you finally get to the point where you've got $5,000, $10,000, or even $50,000 sitting in your account. And every single time you open a finance app or scroll through YouTube, someone is telling you this stock is about to explode. Or if you don't invest in this right now, you're going to miss out. So you hesitate, because the last time you followed hype, you bought something near the top, watched it fall 30%, panicked, sold, and told yourself, investing just isn't for me. And here's the thing, most people don't fail at investing because they're lazy or dumb, they fail because they're playing the wrong game. That's exactly what we're going to talk about today. My name is Noble, and I spend way too much time thinking about investing, money psychology, and why smart people keep making the same financial mistakes over and over again. If you're someone who wants to grow your money without constantly stressing over charts, headlines, or hot stock tips, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Now, today's video is inspired by a book that completely flips how most people think about investing, The Little Book of Value Investing. And before you click away thinking, great, another boring investing book, hear me out, because what's inside this book is not boring at all. It's uncomfortable. It challenges almost everything modern investors are taught, and that's why it works. Here's what most people don't realize. The stock market is not a place where intelligence wins. It's a place where discipline wins. And value investing is basically a system designed to protect you from yourself. Let's break this down. Look, most investors today are obsessed with growth, fast growth, explosive growth, companies that are changing the world. And sure, that sounds exciting, but history tells a very different story. According to data from Dimensional Fund Advisors and long-term market studies going back over 90 years, value stocks, companies that are boring, cheap, and often ignored, have outperformed growth stocks by roughly 3 to 4% per year on average over long periods. That may not sound like much, but this is where math quietly destroys your emotions. Let's say you invest $10,000. At 7% per year after 30 years, you end up with about $76,000. At 10% per year, that same $10,000 turns into about $174,000. That's more than double the money from just a few percentage points. This is where it gets really interesting, because value investing isn't about finding the next big thing, it's about buying what already exists at a discount. Think of it like this. Imagine walking into a store and seeing a high-quality jacket you know normally costs $200, but today it's on sale for $90. Not because it's broken, not because it's outdated, but just because the store just wants to clear inventory. Most people walk past it because it's not trendy. Value investors grab it and smile. Stocks work the same way. But psychologically, this is incredibly hard. Here's why. Humans are wired to chase what's already going up. Our brains associate rising prices with safety and falling prices with danger. This is the exact opposite of how successful investing works. Now, you might be thinking, okay, Noble, but cheap stocks are cheap for a reason. And yes, sometimes that's true, but not always. This is where value investing separates thinking from guessing. Christopher Brown talks a lot about something called intrinsic value. That's just a fancy way of saying, what is this business actually worth based on what it earns? Not what people feel about it, not what Twitter says, not what headlines are screaming about. Let me give you a simple example. Company A earns $10 per share every year. Company B earns $10 per share every year. Company A's stock costs $100. Company B's stock costs $50. Same earnings, same business quality, completely different price. Most people rush to Company A because it's popular and safe. Value investors ask one question: why would I pay twice as much for the same thing? That question alone can save you years of financial frustration. And here's another uncomfortable truth. Over 80% of professional fund managers fail to beat the market over long periods, according to S&P Dow Jones SPIVA reports. These are people with Ivy League degrees, teams of analysts, and access to information you and I will never have. So if professionals can't consistently predict winners, why do regular investors think they can? This is where value investing becomes almost boringly logical. Instead of predicting the future, you focus on price, earnings, assets, and margin of safety. Margin of safety is one of the most important ideas in this entire book. It simply means you don't need to be right about everything. You just need to avoid being catastrophically wrong. If a business is worth $100 and you buy it for $60, you have room for mistakes. If you buy it for $120, everything has to go perfectly, and life rarely works that way. Here's what most people don't realize. Investing is less about being right and more about not overpaying. And psychologically, this changes everything. When you buy a stock because it's popular, you're emotionally attached to price movement. You panic when it drops, you celebrate when it rises. You're constantly reacting. When you buy a stock because it's undervalued, price drops don't scare you, they interest you, because you're thinking like an owner, not a gambler. That mental shift alone can transform your results. Let me tell you a quick story. During major market crashes like 2008 or 2020, value investors weren't asking, should I sell? They were asking, what great businesses are now selling at ridiculous discounts? Meanwhile, the average investor was panic selling near the bottom. In fact, according to Dalbar studies, the average investor underperforms the market by several percentage points per year, not because of bad investments, but because of bad behavior. Fear, greed, impatience. Value investing is basically a behavioral control system disguised as a strategy. Now let's talk about something that might surprise you. You don't need to find hidden gems or obscure stocks to be a value investor. In fact, Brown emphasizes diversification. Owning multiple undervalued businesses reduces risk even further. This isn't about putting all your money into one sure thing. It's about stacking small advantages over time. Here's a simple, actionable framework you can actually use. First, stop asking what stock will go up. Start asking, what am I getting for the price I'm paying? Second, look for companies with consistent earnings, strong balance sheets, and prices that reflect pessimism, not perfection. Third, give your investments time. Value investing doesn't work in weeks or months, it works in years. And this is where most people fail. Because patience feels like doing nothing, and doing nothing feels wrong. But look, compounding only works if you stay invested. If you constantly jump in and out chasing trends, you're resetting the clock every time. Here's another stat that should make you uncomfortable. Missing just the 10 best days in the market over a 20-year period can cut your returns nearly in half. And most people miss those days because they're sitting on the sidelines after panic selling. Value investing keeps you in the game. Now, you might be thinking, Noble, this sounds great, but it's not exciting. Exactly. Boring investing is often profitable investing. The most successful investors in history weren't exciting, they were patient, disciplined, and slightly stubborn. And here's the final point I want to leave you with. Value investing isn't just a way to build wealth, it's a way to think clearly in a noisy world. When everyone is screaming buy, you slow down. When everyone is panicking, you lean in. When prices disconnect from reality, you step aside. That mindset will serve you far beyond investing. So if you take nothing else from this video, remember this: you don't need to outsmart the market, you need to outlast your emotions. Start small, focus on value, demand a margin of safety, and give time a chance to work for you. Because the real secret to investing success isn't luck, timing, or intelligence, it's patience applied consistently over decades. And if this video helped you see investing differently, hit that thumbs up, subscribe for more honest money conversations, and I'll see you in the next one.